America is sitting on a financial time bomb, and it's ticking louder than ever. With the U.S. national debt now surpassing $35 trillion, billionaire investor Chamath Palihapitiya is sounding the alarm, and Bitcoin investors better pay attention. Chamath, known for his early bets on tech and bold calls on financial trends, has recently warned that this massive debt burden could soon explode into a full-scale crisis. Why? Because the government keeps spending while interest payments balloon. In fact, just the interest on this debt is projected to surpass $1 trillion per year, a number that would have been unthinkable just a decade ago. This isn't just about economics, it's about confidence. The global financial system is built on trust in the US dollar. But what happens when that trust erodes? Chamath believes we're approaching a tipping point. Foreign governments are already reducing their holdings of U.S. Treasury bonds, and if that trend accelerates, the cost to borrow money in America could skyrocket. So what does this mean for Bitcoin? On the surface, it might look bullish. After all, Bitcoin was born in response to the 2008 financial crisis, a decentralized hedge against reckless monetary policy. But Chamath warns that Bitcoin is not yet mature enough to fully escape the shockwaves of a global economic meltdown. When markets crash and fear takes over, investors typically rush to safety, dumping riskier assets, including crypto. That's why Chamath calls this the $35 trillion time bomb. If it goes off, the blast could hit everything, including Bitcoin. The key takeaway isn't to panic, but to prepare. Bitcoin investors need to understand that we're entering a highly unstable macro environment. Chamath urges them to stay informed, hedge smartly, and hold with caution. This isn't the time for blind optimism, it's the time for strategic conviction. Because if the US debt crisis triggers a financial quake, the aftershocks will be felt everywhere. In your bank account, your investments, and yes, in your Bitcoin wallet too. In a world gripped by financial uncertainty, many investors have turned to digital assets, hoping to find shelter from the chaos. They see these decentralized currencies as a shield against inflation, corruption, and government mismanagement. But there's a dangerous assumption forming, one that could cost people dearly. The belief that cryptocurrency can rise endlessly, regardless of what happens in the broader economy, is not only misleading, it's risky. The global financial system is deeply interconnected, and no asset, no matter how revolutionary, operates in complete isolation. Let's rewind to March 2020. As the pandemic triggered a massive market sell-off, traditional assets crashed, and so did crypto. It wasn't because the technology failed. It was because fear took over. When investors panic, they sell what they can, not just what they want to. Liquidity becomes the top priority. Cash is king. Now fast forward to today. We're facing a mountain of economic threats: soaring debt, rising interest rates, geopolitical tensions, and the looming risk of recession. These factors create a volatile landscape. In such moments, even the strongest conviction assets can stumble, not due to weakness in fundamentals, but due to pressure from the broader market environment. And here's the reality: digital assets are still young. Adoption is growing, yes, but the ecosystem isn't yet mature enough to absorb massive shocks without flinching. The infrastructure, regulation, and institutional involvement are all evolving, but not complete. Investors who blindly believe their holdings will always move in one direction are playing a dangerous game. The markets don't care about ideology. They respond to fear, liquidity, and momentum. That's why smart investors don't just hold, they plan. They diversify. They prepare for unexpected storms. Chamath Palihapitiya, a seasoned voice in financial circles, often reminds us that no investment exists in a vacuum. If the world economy takes a hit, every part of the market feels it. It's not about doubting innovation. It's about respecting the forces that shape markets. Hope is not a strategy. Preparation is. So whether you're holding for the future or trading for the present, never forget, timing, awareness, and flexibility are just as important as belief. Stay sharp, stay informed, and don't assume that any asset is untouchable. As we look ahead to the coming months, the global economy finds itself on fragile ground. Markets are tense, policymakers are cornered, and investors everywhere are bracing for the next big shift, one that could reshape how people protect and grow their wealth. There are growing signs that the financial environment is entering a high-stress phase. Consumer demand is cooling, business growth is slowing, And central banks, after years of aggressive interventions, now find themselves trapped. On one side, they must fight inflation. On the other, they risk triggering a slowdown by tightening too far, too fast. For everyday investors, this creates a dangerous mix. When confidence weakens and uncertainty rises, people begin pulling money out of riskier assets. Not because those assets aren't valuable, but because fear starts to outweigh logic. It becomes less about long-term potential and more about short-term survival. Historically, we've seen this play out again and again. When the financial system starts showing cracks, the flight to safety begins. People run toward what they consider stable, whether it's cash, commodities, or defensive stocks, and away from what they view as volatile. The result, even strong investments can tumble, not due to failure, but due to panic. Digital assets, while revolutionary, are still part of this broader market psychology. Despite the innovation and belief behind them, they are often the first to get hit when anxiety rises. It's not a flaw in the technology, it's a reflection of how human behavior shapes markets. That's why seasoned voices like Chamath Palihapitiya urge caution. Not fear, but discipline. This is the time to understand your portfolio, to ask the hard questions. What are you exposed to? What's your plan if liquidity dries up? How do you balance belief with protection? These are not just theoretical questions. They're the ones that determine who weathers the storm, and who gets caught in it. This isn't a moment for blind optimism. It's a moment for clarity, strategy, and mental strength. Because the tides are shifting. And when they do, those who prepared will not only survive, they'll have the chance to thrive when the dust settles. For years, the digital currency movement has captured the imagination of investors around the world. It represents freedom, innovation, and the promise of a decentralized future. But with great opportunity comes great uncertainty. And those who truly understand the game know that success isn't just about what you believe, it's about how well you prepare. It's easy to get caught up in the hype. Stories of overnight millionaires, parabolic price movements, and tweets that shake markets. But behind every surge is a silent truth: markets move in both directions. The smart money doesn't just ride the wave, it plans for the crash. Champions of this space, like Chamath Palihapitiya, understand this balance better than most. They don't simply buy and hold blindly. They build strategies. They take profits when it makes sense. They hedge when risk levels rise. They hold conviction, but pair it with caution. In this volatile ecosystem, anything can happen. One day, adoption is surging. The next, regulation sends shockwaves. One week, mainstream companies embrace the asset. The next, a macro event pulls capital out of the market. It's not about predicting every move, it's about staying ready for whatever comes. That means having a plan not just for the upside, but for the downside too. What happens if a major sell-off begins? What if liquidity dries up? What if your emotions tempt you to make impulsive moves? The disciplined investor doesn't wait for panic to decide. They act on logic, not fear. Diversification, stable cash reserves, clear exit points, these are not signs of doubt. They are signs of strength. The wisest participants in this space know that the road to long-term wealth isn't paved with constant wins. It's built on smart risk management, patience, and adaptability. This isn't about playing defense, it's about playing to win over the long haul. Because when markets shake and others freeze, the ones who saw both sides of the path will be ready to act, not react. They won't just survive the volatility, they'll use it. So ask yourself, are you hoping for the best? Or are you planning for it, and everything that could come with it?